90% of active market participants don't beat the market in the long run. Now, I'm not breaking any news here. Unless you've been living under a rock, you know this. But what's the reason behind it? Is it that all these traders and investors, are they bad? Do they not know what they're doing? And the answer is no. It's actually a mathematical impossibility for market participants to beat the market. It's never going to happen. It's impossible. It's like looking at basketball and saying, hey, all these NBA teams that dedicate their lives to playing basketball, how come their average score isn't higher than the league's score? And it's like, well, because they're the ones who said it. They're always going to be the same. The average NBA basketball team score is always going to be equal to the league score. If every basketball team scores 10 points more, the league's average score is going to be 10 points more. It's always going to be equal. It's the same thing in the financial markets. The average return of the market is always going to be equal to the average return of all the market participants, all the investors, traders, everybody who has money in the financial markets. Because it's the same stocks. They're holding the same stocks. So all the stocks that are in the market are held by all the market participants. If the stocks go up, market participants' return go up. If the stocks go down, market participants' returns go down. Now, the average of the market return is going to be exactly equal to the average of the market participants who hold these same stocks, right? Now, market participants in the process of trading incur costs. There's fees involved. So their returns are always going to be slightly lower than the market returns, right? So market participants mathematically can never, under any circumstances, have a higher return than the market's return. If market participants decide to trade stocks higher, market returns are going to go up. If they decide to trade stocks lower, market returns are going to go down. So it's important to remember that it's not that the market moves and then traders and investors' returns move. It's market participants who, through price discovery, through transacting with one another, set market returns, right? They're the ones who set it. If traders see that the market isn't going to be doing well and they start bidding prices down and the market crashes by 50%, it's market participants who traded stocks lower, and the market returns follows or displays that information. So it's always, when people say, hey, how come all these financial market participants, they don't beat the market? And it's like, well, they can't. The market return is it's the score. Now, depending on how active you are, the odds of beating the market in the long run becomes lower. The more active you are, so if you're day trading or even shorter term trading, the odds are even lower versus how inactive you are, because there's less fees involved in that process. Now, this idea was initially brought up in an article by William F. Sharp called The Arithmetic of Active Management. And arithmetic, because it is simple arithmetics, right? It's addition, subtraction, multiplication, and division, and you can make this calculation. William F. Sharp is a Nobel Prize winner in economics. If you studied finance, he's the guy who came up with the CAPM model, so capital asset pricing model. It's this guy. So you can read this, but the point now is, okay, knowing that, yes, some market participants will beat the market in the long run, knowing that the average market participant is going to lag the average market returns in the long run, well, doesn't that make index funds a really good investment? And the answer is yes, because when you invest in an index fund, you get the average market return, which is equal to the average market participant return. So all these traders and investors who dedicate their lives to the financial markets, who spend all this money on it, who have Bloomberg terminals, you get the average of their return. So the ones who outperformed the market, the one who underperformed, you get the average of all of them, but without incurring any fees or spending any time on it. So yes, index funds are like a cheat code in a way, where you get the average of everybody without having to do anything or spending any money. So it's a cheat code. Now, that being said, financial markets can't work just on index funds. You need active market participants, investors and traders, for prices to reflect information correctly, for markets to be efficient. You know, if everybody just invested through index funds and you had a company that went bankrupt, it wouldn't even move in its positioning unless there was some active market participant that trades it. Because when you invest in an index fund, let's say you put $100 in an index fund, that money is spread across all the stocks in that index, not proportionally, but in a capital weighted way. So if a company was, let's say, the 10th largest company in the S&P 500 and they went bankrupt, if everybody was just investing through index funds, that company would still be the 10th largest company. It wouldn't move in its positioning. You need active market participants to push it down. So you need traders and investors for a well-functioning market and for markets to be efficient. And again, unless you have a capital market that's efficient, it won't attract as much money. So you need well-functioning, efficient markets that's going to attract capital, and you want these active market participants to direct that capital where they're most needed, right? So if investors and traders see that the future is in electric vehicles, well, they're going to push up that industry. And within that industry, they're going to find the companies that are best suited to make things happen and push those stocks up and put those stocks in the best position to achieve those things. So well-functioning capital markets are not only important for investors and companies, but for society as a whole. So it is something that's required, but where at the same time, the odds aren't great. It's like opening a restaurant. We need restaurants, but if you open a restaurant, you have an 80% chance of going bankrupt in the first 5 years. If you want to start a YouTube channel or start streaming, I think, you're in the single digits success rate. If you launch an app on the App Store, I think it's a 99% failure rate. But all these things, we need them. It's just the success rate is super small in them. So in the financial markets, if you are actively participating, even though it's good for the whole market, you're on a personal level, your odds of success are low. And that's just something that you have to know. And it's just the fact of the markets. Now, I don't want to ramble on too much about this. I think I just wanted to talk about the fact that, hey, it's just mathematics, because I always see videos about, you can't beat the market. The average market participant can't beat the market because they don't do proper risk management, or they don't know how to do fundamental analysis. And it's like, no, this isn't the reason. It's even if everybody was better at risk management, at getting news faster, yes, on an individual basis, doing some things different can help you. But when you look at the average is always going to be lower. Anyways, I don't want to ramble on. This is it for this video. Let me know what you guys think, and I'll see you guys tomorrow.